Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, August 15th, and then we'll see how things look for Wednesday, August 16th. We had a pretty significant down day. We also broke below support. So in yesterday's thumbnail, I said, can support hold? Well, the answer for right now is no. The things that we were seeing that are negative on our charts, they're following through, where the little recovery that we saw on Monday, that had no follow through at all. So the market is now resuming its downward trend. We're going to try to figure out where's the next level of support. Are we going to go all the way down to the 200-day moving averages? We do have a lot of other moving averages and a lot of other support levels before that. We'll have to see if some of those work out. There are some positive things in the background, and I'll try to point those out as I go through the video. Please be aware, I am going to offer an online class in September. I haven't set the date yet. I'm still waiting for some other things to come together to actually set the dates. It looks like I'm going to do 2 classes. I've had some people that want one longer class. Other people would prefer to have shorter blocks of time, but then span it over 3 days. I have no problem doing both. I've been teaching for a long time, and I'm used to doing both kinds of classes. I will be covering my approach to technical analysis. I'll also be going through at a high level some strategies that you might want to consider, and I'll also be dealing with support and resistance. Let's go back and talk about what happened. Right at the open, we did have a gap lower open below the daily pivot at 44.78. We also dropped below S1 at 44.65. We found kind of loose support. We were a little bit above, a little bit below the 44.50 level. As the day went on, we tried to bounce, but that wasn't happening. We fell back to around the 44.50 level before dropping even further, going below S2 at 44.41, and then we closed just under S2. We were down 1.16%, and volume still continues to be below average. We are negative with our technicals. We're more oversold now in the short term. We're slightly oversold in the intermediate term. The long term is still hanging in there as long as we're above the 200-day moving average. It's about inflation and interest rates, and now there's a new scenario coming out that's having more growth concerns that I'll cover here in just a moment. What are some comments that we can make? The S&P found and then lost support at its 50-day simple moving average. As of Tuesday, that calculated out to be 44.47. Here's the new scenario that it has more growth concerns behind it right now. Number 1, China had weaker than expected retail sales, industrial production, and fixed asset investment data. So they ended up lowering their rates to try to stimulate their economy. A lot of companies do business with China, so that affects a lot of American companies. Fitch came out again and warned that it might downgrade the ratings of dozens of additional banks. We had some Fed speak. Minneapolis Fed President Kashkari said that banks may need to face tougher capital regulatory standards. So is the banking issue starting to come back into play again? Bank stocks were weak on this news, which is understandable. Interest rates continue to climb, and that's really kind of what's spooking the market for right now. On a short-term basis, we have the Stochc RSI, the Williams Percent R, the CCI 14 and 20, and the stochastics giving us extreme negative readings. We added the Williams Percent R and the CCI 14 back on the list after they had come off. On an intermediate-term basis, we have the S&P McClellan oscillator starting to get extreme negative, and one chart in our PMO studies is also looking extreme negative. The dollar was up and interest rates were up. That also produced headwinds for stocks. All of the yield curves that we follow still remain inverted. Sentiment is still positive, but we really dropped down to 57 where we had been at 65. Our trend is more neutral now. It's really hard to distinguish this when I was looking at the numbers. The red line and the green line are right on top of each other, but it is a weakening trend because the ADX is below its moving average, but it's still above 20, so we're still in a trending environment for right now. Our bias is negative and our momentum is negative. The economic reports that came out, we had total retail sales. They came in stronger than expected at 0.7% month over month. They expected it to be up 0.4%. Last time it was up 0.3%. If you take out autos, we were up 1% month over month. They expected it to be up 0.4%. Last time it came in up 0.2%. So both of these were greater than expected. The Empire State Manufacturing Survey, it came in at minus 19. They expected it to come in at a plus 2.4. Last time it came in at 1.1. When we see a reading below 0, that shows a contraction in manufacturing in the New York area. Import prices were up 0.4% month over month. Export prices were up 0.7% month over month. Year over year, import and export prices, the import prices were down 4.4%. Export prices were down 7.9%. Business inventories were unchanged. They expected it to be up 0.1%. Last time it was up 0.2%. The NAHB Housing Market Index came in at 50. They expected it to be at 56, and last time it did come in at 56. Looking at some charts of the economic reports that came out, we are seeing a bit of an increase in retail sales year over year, and that's spooking the market a little bit. On one hand, you can say, well, that's good, that's healthy. There's a lot of retail sales going on, but at the same time, as we see this going up, they're worried that it might be inflationary. Retail sales on a month-over-month basis did show an advance in the latest reading. Looking at import prices, they have been declining overall. When we look at it on month-over-month, they have been increasing. But year-over-year, they're also coming back up a little bit, but they're still down overall. Looking at export prices, which in total continue to decline. On a month-over-month basis, they are showing an increase where they had been negative. And year-over-year, also showing a bit of an increase where they had been negative. The Empire State Manufacturing Index, where we've been chopping above and below the 0 level for most of 2022 and even into 2023, we seem to get a good report, then we get a bad report, and it just goes back and forth like a ping pong match. Looking at business inventories, we're right down at about 0 when we look at the change in inventories. And the NAHB Housing Market Index, after coming back up and showing some improvement, is now starting to show some weakness. Some IsabelNet.com blog charts, equity positioning. When you have a systematic strategy, that means you have a system and you don't deviate from that. There's no emotion. You just do what the system says. Then you have discretionary type strategies where you can pick and choose. You can decide when to get in. That's based around using more of your emotions and intellect and some kind of logic, which sometimes has its benefits but also has its detractors. Looking at the dark blue line, the systematic strategy seems to be holding up the best. Overall, that's the blue line where we're seeing a decline. Discretionary, since folks are tending to use their emotions, that's where we're seeing most of the drawdown, even though we're still positive with all of those strategies. The copper to gold ratio, and I cover this in the intermarket analysis video each weekend. The copper to gold ratio, it's often considered to be a leading indicator for the 10-year treasury yield. We plot that on the chart as well. If the copper to gold ratio has been going down, does that mean that interest rates should be coming down? We're seeing a really wide disconnect between these two currently. The 10-year treasury yields. The futures market thinks they're going to be right at about where we're at right now, where Goldman Sachs is forecasting that we're going to see a decrease in interest rates. Looking at the S&P 500 and the price where it's at right now and comparing it with earnings per share, Goldman Sachs is still having a pretty rosy outlook looking forward. The current projection that the market is focused on is this dark blue area where it has the S&P rising to 4,500. Looking at the year-over-year earnings per share growth, it's weak right now, but they are projecting things to look better into the future, which justifies higher stock prices. And yes, I did put this red arrow on here to show the overall consensus from pretty much everybody thinks that earnings are going to improve. The overbought and oversold composite, after giving us a really high reading, has been dropping back down. The equity allocation, after it had been at 66, it's now coming to 65. As we've been seeing some weakness in the market lately, at least according to Bank of America, we're seeing some folks pulling money out of the markets. The exposure to bonds also showing a decrease as interest rates have been going up. The sector fund flows over the last 4 weeks, you can see all the different categories down here. Based on the sectors that we look at, we're seeing a lot of money going into telecom recently. When you look at the S&P 500 and you take out energy, the profit margins are really showing some improvement over here on the right-hand side. Let's get into our charts and analysis. Here's the intraday chart where we gapped lower below the daily pivot. We went down below S1. We didn't make it down to S2. We would save that for later. We tried to come back up. That wasn't really happening. We came right back down to about this 44.50 area, which we've been watching as a potential support area, and the market just kind of danced along there. Well, late in the day, we saw some selling come in. We broke down below S2. We saw a little bit of bounce up from that, but we still closed below S2. Here's the intraday chart where we were seeing some nice strength in the initial overnight session, but then everything opened in Europe. Some news came out of Russia. Europe had a difficult time. That shot the U.S. futures down, and they just started to get more weak. We did see a little bit of a bounce up after the retail sales report was released, but that quickly led to some more selling. We ended up seeing a lower open for the S&P and how we dropped down, showing a little bit of a bounce in the initial overnight session. When we look at large cap growth and value, they both had difficult days, but growth just slightly outperformed value. So on a closing basis, everything was down, but growth was down less than value for the large caps, mid caps, and the small caps. I was watching this as well. We saw a real spike up right at the open, thinking maybe this will give the market some support, but it just wasn't happening in Tuesday's session. Looking at sentiment, with the down day, we're seeing an increase in the Ulcer Index. Also, we're seeing the VIX with the line chart and the bar chart continuing to advance. Volatility is starting to pick up again with the down day. We're also a little concerned about this. We take the VIX and then a 3-month average of the VIX and make a ratio. We're starting to see this red line turning back up. That means that fear is coming back into the market longer term. We're also a little concerned about this. When we look at the ratio between the VIX and the VVIX, which measures the volatility of the VIX, this is also starting to turn up as well. For things to turn more positive, we want to see this ratio continue its decline. The VIX to move ratio also saw it tick back up above its moving average. The equity put call ratio, this has been negative, but we've been watching this for a while. The 5-period simple moving average of the equity put call ratio continues to advance. Here's a longer term look at that same chart. The equity put call ratio, very long term, based on 253 periods, it's starting to turn back up after it had been declining. We're still watching this to see if the longer term picture is turning back more negative. But you can see other times where we turned up for a brief period of time and then started to decline. That's what we're wondering. Will that happen again this time? The one fear gauge that we look at did show an increase, and it's been increasing overall. The other fear gauge that we keep an eye on was pretty much flat. The ratio between risk on and risk off is still seeing some weakness here. After it had been in an uptrend, it's more in a shorter term downtrend. Our advanced decline line studies, we saw a decline based on price and volume, but we're still above the moving averages. New highs, new lows. We're declining with the 5-period and the 10-period. Didn't see many new highs, but we are seeing a little bit of an expansion of the new lows. When we look at our advanced decline ratio, both lines are now dropping below 0. That's negative. Accumulation distribution. I pointed this out yesterday. It looked like maybe we were showing some improvement going back above the moving average. Nope, didn't see any follow through there. The cumulative advanced decline line for the NYSE, that's showing some weakness, and we're dropping below this trend line. We're seeing some weakness on our regular advanced decline line, but we're still above this upward sloping trend line on this chart of the NYSE advanced decline line. When we look at common stock, we are seeing a decline based on price and volume. In the background is this negative divergence that we were seeing. Is that starting to play out now? When we look at our advanced decline line studies, we're dropping below the moving average with the NYSE. We're coming right down to the moving average with the S&P. We're also coming down to the moving average with the mid caps, and we're slightly below the moving average with the small caps. Here's our trend, and this is what's a little confusing. If you can see the green and the red lines here, they're right on top of each other, so that's neutral in the intermediate term. But we do have a weakening trend since the ADX is below its moving average. In the short term, we're a little bit more negative here with the red line crossing above the green line, even though that's probably hard to see. But we are going now into a trendless environment as the ADX drops below 20, and volume continues to drop off. Our short-term analysis, we did close down below the 50-period moving average. That's seen as negative. On the bottom, you can see where volume continues to drop off. We're coming down to the last part of our short-term rainbow now. The longer we stay in here, the more ruffled these lines will become. With our 20-period moving average, we saw a decline as well as the 50 and 200. The Stochk RSI is extreme negative, as is the Williams percent R. the CCI 14, and the CCI 20. All of these are extreme negative. With the stochastics, we're looking extreme negative in the short term, intermediate term, and we're looking just plain negative in the longer term stochastics chart. The force index is still negative and not necessarily extreme. Our intermediate term analysis, we're dropping below the midpoint with the balance of power. The go-no-go system is turning to a brown bar, so that must be more negative. The highest high and lowest low values, we're seeing price decline as the lowest low value continues to decline. The highest high value continues to be flat, and we're below the midpoint. And the midpoint itself is declining. The TTM squeeze is also turning more negative with the lighter colored red bars. We're dropping down into the second standard deviations now, showing that we're in a more solid downtrend currently. We're also coming down to the lower end of the Bollinger Band, but we haven't exceeded the lower band yet, suggesting that we've gone down too far too fast. So this is just plain negative for right now. We're also coming down to the top of our intermediate term rainbow. That's the 50-period moving average. Are we going to continue to go down into the rainbow, or will the market find support at some point and be able to bounce up out of that? The ease of movement continues to be below zero and is declining. The Arun is also declining. We're still positive, but we're seeing a real trailing off of buyers, and we're pretty much flat with sellers. The oscillator itself is still above zero. Here's where we're getting a little extreme negative. The S&P McClellan oscillator has now gone extreme negative. We're showing a decline with the summation index based on price, and we're starting to drop below the midpoint based on volume. So this is turning a little bit more negative. The NYSE McClellan oscillator is not extreme negative yet, but continues to decline. So the summation index for the NYSE, we're declining based on price and volume. The Swenlin trading oscillator continues to decline based on price and volume. The Elder's impulse system for the S&P has switched to negative. The PMO shows that momentum is negative. We're declining based on price and volume. We're starting to get extreme negative with the percent of PMOs that are rising. We're still declining with the buy signals and not extreme, and we're also still declining with the PMOs that are above zero. The parabolic SAR continues to be negative with the dots on top. Please be aware that we did see a negative signal in the weekly chart over this past weekend. The slope shows that in the short term, the momentum continues to be negative. Our MACD is also continuing to be negative, and we're coming down here to this zero line. Will that make a difference? But then when we look at all of our oscillators, we are showing that momentum continues to be negative across the board. We did come down below the 50-period simple moving average, but believe it or not, we're still above the exponential moving average. We're right in between the two right now. Most folks focus on the simple moving average, but we also want to keep an eye on the exponential moving average. Looking at our moving average tree, again, showing how we're right in between the simple and exponential moving average for the 50. If we continue to drop, are we going to get down to the 100s? Is that going to offer support? Or are we going to go all the way down to the 200-day moving averages? The bullish percent index continues to be negative overall as it declines. The NYSE bullish percent index is declining but is still above 50. The Chaikin money flow, we thought we were seeing some improvement. Nope, didn't follow through into Tuesday's session, so we're seeing the smart money doing some selling right now. The Chaikin oscillator, which was right about at neutral after Monday, it's now dropping a little bit more negative below the zero line. The money flow is below 50 and declining. The ultimate oscillator also ticks sideways but is still below 50. That is negative. The vortex, we're seeing the red line going up and the green line going down. That is negative. The RSI, we are dropping below 50, both with the 14-period and the 9-period RSI, and not giving us an extreme reading, at least yet. On balance volume is still coming down to the moving average. That's hanging in there a little bit, but if we drop below the moving average, that'll turn things more negative, especially if it stays under the moving average and then the moving average starts to roll over. We did see a decline with the 200-day moving average study for stocks in the S&P 500. Also saw a more pronounced decline with those stocks above their 50-period moving averages. Our Fibonacci and line studies were coming right down here to this trend line, where now that it's recalculated, I came up with 44.50 when I first put this number on here. As we're coming down to this level, it's coming out to about 44.38-ish or so. I draw these lines myself, so be aware of that. I just have to eyeball where these are supposed to go, so it may not be an exact price level. But so far, based on what this chart is showing us, we're still holding up with support, but we could easily drop below that if we see more selling. Our different charts, we're negative across the board with the hike in ASHI, the KEGI is negative, the Renko is negative, and the 3-line break is negative. Our indexes, we did see the equal weight index underperform the S&P 500 itself, where a lot of stocks really got hit in Tuesday's session. When we take a ratio between the S&P and the equal weight S&P, we did see this tick up since the bigger stocks held up a bit better than the broad market. Dow theory, we did see a decline with the Dow. We also saw a decline with the transports, and we saw some really continued weakness with the utilities. The transports to S&P 500 ratio did decline, but it's still in a longer-term uptrend. When we compare the transports to the S&P 500 and take a correlation, their relationship is coming down a bit, but it's still quite strong. This is kind of interesting. When we look at discretionary and staples, we look at their equal weight indexes and then take a ratio of that. We actually advanced a little bit in Tuesday's session. The Dow is coming right down to the pivot point right now. Will this support level hold, or are we going to come down and check the 50-period moving average on the Dow? The diamonds have switched from positive to being negative with the Elder's Impulse system. The NASDAQ, after coming back up to the 50-period moving average, that now seems to be overhead resistance, and we have fallen back down. When we look at the Fibonacci chart for the NASDAQ, we're still below the 61.8% retracement level. And we're also showing weakness when we look at the cumulative new highs and new lows for the NASDAQ. The raw score continues to be below zero. The NASDAQ 100 also came back up to its 50-period moving average, but that may be acting as some kind of overhead resistance for right now, and we have now fallen back below that. The Qs, though, still remain neutral. When we look at the momentum for the NASDAQ 100, we're coming down to this zero line, which I pointed out in yesterday's video. Will this offer some kind of support for the NASDAQ 100? If we continue to fall, then no, it won't. But if we see a little bit of recovery, other times we got down a little bit below zero before bottoming out and then bouncing from that level. The bullish percent index for the NASDAQ 100, that was flat. That's a little bit positive right there. To have a down day and to see this not decline is positive. The small caps, after coming down to the 50-period moving average, we closed up off of that. Looked like, okay, maybe we'll get a recovery here. Nope, we ended up closing down below the 50-period moving average. When we look at the Russell 2000 index, we are declining with the RSI. We closed down below the 50 on this chart, and the MACD continues to be negative. The small caps for the Elder Impulse system still remain negative. The ratio between the small caps and the S&P continue to show that small caps are underperforming in the short term as well as the longer term. When we look at small cap growth to value, this is kind of encouraging. We saw a real nice bounce from small cap growth compared to value. We're in a shorter term downtrend, but longer term we continue to be in an uptrend. The mid caps also dropped below their 50-period moving average. We were watching that as well. That support level did not hold. The Elder's Impulse system for the mid caps has now switched to negative. Also, when we look at mid cap growth versus mid cap value, we did see a nice bounce here. So overall, we continue to be in an uptrend. Is that scenario that Tom Bowley was putting forth with his research that August is a good month for growth to outperform value? Are we going to see any follow-through for that? The dollar continued to be up, which is putting some pressure on stocks. The FANG index never came back up to its 50-period moving average before declining. But if you look at this, home construction, even on a down day, even with interest rates going up, we're seeing this ratio continuing to go up when we compare it to the 3 to 7 year bond ETF. Keeping an eye on banks, they finally dropped below their 200-day moving average. The financial sector also came down to the 50-period moving average after giving us a recent golden cross. When we look at the financials and compare it to the S&P, we did see some weakness and we're in a longer-term downtrend. The regional banking ETF did turn down when we compare it to the financial sector, and longer term it continues to be in a downtrend with this ratio. Keeping an eye on bonds, we're seeing interest rates going up, which is causing some problems for the market as bond prices continue to fall, and we're looking negative based on price. The RSI is declining. We just generated a recent death cross, and the MACD is also declining. But when you look at riskier bonds and compare them with more conservative bonds, folks are still preferring the riskier bonds, even though this ratio ticked down slightly. This is something that has been a concern and something that we've been watching. As this ratio's been going back up, even when the market was going up, this was causing us some concern. We saw this ratio really picking up on Tuesday, and that could also be adding some pressure to stocks. We're still above the 3-month yield set back in 2007, even though the 3-month yield ended up closing unchanged on the day. Looking at the Special K daily chart, we are rolling over a little bit, but we're still above the red line, so this continues to be positive. We're also coming down in our longer-term rainbow to the 50-period moving average. This looks nice and smooth right now. If we continue to fall, it's going to make these lines start to jiggle around. Looking at our PPO studies, now in the long term, we're pretty much flat. We're showing some weakness in the intermediate term, and we've dropped back below zero in the short term. We're also coming a little bit further underneath this resistance level when we look at the weekly chart of the S&P 500. We also are dropping down below this resistance line with the NASDAQ 100 weekly chart. This is another thing that's negative and remaining bigger in the background, the ratio between the NASDAQ 100 and the Dow. We saw this coming down a little bit. Other times when we hit a really high level, close to where we're at now, we saw a real decline after that in the market. Is that going to be what happens this time? Or are we going to get a bounce and this will see some recovery and we go up and test this previous high level where we've been before? Going back and giving some updates of our possible positive scenarios, there's actually some positive things that we're seeing here. When we look at the Qs to the S&P, it turned up just a little bit, but is still below the moving average. Discretionary, which has been doing quite well lately, it's now falling below the moving average. And large cap growth versus large cap value did see a bit of a bounce here, but is still below the moving average. Where we're seeing some improvement are in the mid caps and the small caps growth to value ratios. We did see some improvement with the large caps, but the mid caps are going above the moving average, and the small caps are also going above its moving average. The S&P to utilities ratio, it's continuing to go up. We're not seeing that with the S&P, but if you look at other times when this was really going in one direction, you'll see that the S&P was going in that same direction. But when we look at the broad market now, we're dropping below zero when we take a 5-period moving average of the highs minus the lows for the Amex, NASDAQ, and NYSE. We're also seeing a further decline with our 10-day average of the S&P 500 highs minus the lows. We had been camped up here in this extreme positive area for quite a while. Now we're starting to drop. We're also looking more negative with the 19-day exponential moving average of the advanced decline ratio. We're dropping further below zero based on price and volume. We're also turning over a bit with our 50-period exponential moving average of the new highs minus the new lows. This is coming down now, but it's still above zero. That's because the black line, which is our indicator, it's now dropping below zero, which is causing the red line, which is what we used on the previous chart, it's rolling over as well. This is another potentially positive area on a down day. S&P growth outperformed S&P value, and we saw a nice little bounce up in this ratio. Now we need to see follow through with this. We want to see this really scream into the upside to give us more of a positive backdrop. Not just one day here and one day there. We want to see this really show some strength. So we'll be keeping an eye on this to see if there's any continued strength in this ratio. The Staples to S&P 500 ratio also has been continuing to decline. It did give some support to the S&P. This ratio has been chopping around a little bit. If it continues to fall, will it end up giving more support to the S&P? And then looking at Tom Bowley's research where he says energy is not hot in the month of August, where tech tends to be hot. Not really seeing that much played out right now. We're in the middle part of August where we tend to see some kind of a bounce. Historically, that's what we've seen. We're just not seeing it happen based in reality. And then down below, this is where he says from the months of May through August, we tend to see growth outperforming value. So our outlook for Wednesday, we will still get some earnings reports, but not as many as we had been receiving. The technicals are negative, and now we've dropped below the 50-period moving average. The simple moving average. We're still above the exponential moving average. The economic reports coming out, we'll get the weekly MBA mortgage applications index, the housing starts as well as building permits. These tend to be leading indicators. Industrial production and capacity utilization will be coming out, and we'll get the FOMC meeting minutes at about 2 p.m. Eastern Time. The geopolitical events, we're keeping an eye on all of these things, but it's about inflation, interest rates, and now growth concerns are coming more into the picture. Here's the updated economic calendar for the week. Please note on Thursday we will get the LEI, and then on Friday we don't have any reports coming out. For the Stock Traders Almanac statistics, for the Dow we are neutral to positive on August 16th, where we're more positive with the S&P and the NASDAQ when you take all years together. This is when we just look at the third year of a presidential cycle, the pre-election year, where we tend to see historically some kind of a bounce from here. We're not really seeing that yet, more than one day that we saw on Monday, but historically we have tended to see a bit of a bounce here. We're also wondering, is the NASDAQ ever going to hit this bottom in the early to mid part of August and then finally start to bounce back up? Hasn't really been happening yet. Then when we look at the pre-election year for the S&P 500 and take that all together and compare it, the purple line is where we're about at right now. We're following the green line, which does show a bounce going into the latter part of August. We're just not seeing that yet. We will be on the 12th trading day of the month in August. And when we look at that, the 12th day, we're supposedly coming close to the end of what's supposed to be historically a positive time for the market during a pre-election year. But we're just not seeing that played out. So looking at our scenarios, we're still going with the down one, and we've been there all along. It was kind of hopeful that maybe the 50-period moving average would provide some kind of support. We were seeing some improvement on Monday, but that just didn't follow through into Tuesday. So for our down scenario, we're being more justified because our technicals are negative, and now we're going below the 50-period simple moving average. We can't go with the up one right now. The charts just don't support that, and it's really dangerous at times like this to try to front run the market. We could go with the sideways trend because our shorter term ADX is dropping below zero. Intermediate term, we're neutral right now because the green line and the red line are right on top of each other. The warning signs, we did see a convergence of these short-term bearish signals and they've been playing out. We thought it might have been finished after Monday's session, but apparently there's still some more to go. We'll see if Wednesday sees a continuation of that. The longer-term trend signals were dropping below the moving averages with the S&P and NASDAQ weekly charts. That will take some time to play out to see if that's turning more negative. Seasonally and historically, August tends to be a weak month, and so far that's what we're saying, but we should be entering a positive time during a pre-election year. We're just not seeing a lot of follow-through yet. The S&P 500 oscillators are negative, and the NASDAQ 100 oscillator continues to be negative, but it's coming down to that zero line. We'll see if it continues to fall. Will that provide some support? We'll also be watching the MACD coming down to that zero line. Will that provide some support as well? The VIX is still showing a lot of complacency overall, but it's continuing to climb as we see more down days. The S&P, the NASDAQ, and NASDAQ 100 have all dropped below their 50-period simple moving averages. We're still dealing with the exponential moving averages. The cumulative new highs, new lows for the NASDAQ continue to show weakness. The 3-month yield is above where it was back in 2007. Even though we were unchanged, we're well above that level. S&P 500 growth is weakening, but it's still in an uptrend and saw a bit of an uptick in Tuesday's session. The weekly pivot, which we're going back almost 3 weeks now, that's where we topped out, and we've been having trouble ever since then. The parabolic SAR is negative on the daily chart, and it's also negative on the weekly chart. The vortex continues to be negative, and we're still dealing with earnings season, even though that should be slowing down a little bit. The positive signs, we still have seasonality and setups that are in the background that I covered in the weekly video. Those are still there. The long-term daily special K chart is still positive, even though it's rolling over, where the weekly chart is negative. The equity put call ratio, the long-term chart is positive, but it's starting to turn up, so we're watching that. The S&P remains above the downtrend channel upper line. We're still far away from that level, so I haven't been showing that chart. We're still in a risk-on posture, but we have been seeing some shorter-term weakness in that ratio. The S&P is outperforming utilities. The Staples to S&P 500 ratio is declining. Both of these should be able to give support to the S&P. The Russell and the small caps, as well as the mid caps, have generated recent golden crosses. Small and mid cap growth continues to be positive, and we saw a bit of an uptick on Tuesday with those ratios. The financial sector, even though it got hammered on Tuesday, it still generated a recent golden cross. It's come back down to its 50-period moving average. Our conclusion, we are negative and we're below the 50-period simple moving average now. In the short term, we're negative and we're getting a little bit more oversold. In the intermediate term, we're also negative and becoming more slightly oversold. In the long term, we continue to be positive. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.